Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. President Trump says he'll move ahead with unilateral tariffs within the next 2 weeks, while the US Commerce Secretary warns the EU is likely to be among the last to secure a trade deal. Washington orders some embassy staff to leave Baghdad after Iran warns of retaliation in the region if it comes under attack. Oil prices moved higher on Wednesday. Plus, stock futures and the dollar slide after trade headlines, but markets watch incoming UK data and today's 30-year Treasury auction.
A risk-off mood clearly in the markets, Anna. You saw it on your screen, but I'll reiterate it right here. The Euro Stoxx 50 futures down about 0.9%. The FTSE 100 following that risk-off mood. And you're seeing that show up in the commodity sector as well. Although keep an eye on what's going on in oil. We do have some Middle East tensions that may be changing the tone when it comes to commodities. And, of course, who's benefiting from all of that risk-off? The euro, 115 handle on that currency pair. The countdown to the opening trade starts right now.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is, like I did with EU.
President Trump says he's going to be sending letters in the next couple of weeks. We will see how that transpires and develops. There are lots of ways we're going to be talking about US exceptionalism during this programme today, whether that's on debt sustainability, whether it's on equities, whether it's around the tech agenda, a lot of conversations taking us back to the United States. And let's go there first in the shape of the trade narrative, Kriti. Not for the first time. We start with the latest on President Trump's trade agenda.
Yeah, it's fascinating. In that soundbite we just heard, he says he's going to start treating a lot of the other countries that had perhaps positive trade notes, South Korea, Japan, they named, in the same way as the EU, which isn't exactly a sign of optimism when it comes to potential tariffs, potential letters that are going to be issued in the next week and a half or 2 weeks, as he suggests. I think it's fascinating, though, because we are still talking about this on a country-by-country basis. We haven't even gotten to the sectoral yet.
Yeah, absolutely. And it's, well, apart from steel and aluminium, but right. Yeah, you're right, pharma, all the other sectors we were talking about for a long time. It's interesting that the market has taken this slightly risk-off, hasn't it? We've got futures pointing lower in Europe, in the United States. The dollar is off, the yen is higher, gold is higher. We're going to fold in a moment some of the dynamics around the oil markets, but it seems as if at the margin, this latest tariff news, the sense that President Trump is trying to draw a line in the sand and impose terms on the rest of the world is being seen as risk-off. There could be a risk-on interpretation, which is that if America is very firm in this sense, perhaps we get certainty and we're able to move on. But maybe that isn't even certainty if we see the US administration impose particular rates.
Absolutely. A complete 180, though, from where we started the week, or perhaps on Monday, Tuesday, where there was a little bit of optimism that if you have the world's two largest economies in the world being able to find some common ground, perhaps it paves the way for some others. But again, it comes back to this question of China is just one part of the story. It is that uncertainty that continues, and how quickly can Donald Trump, even when it comes to China, not just in the tariff part, but allowing, say, for example, visas or student visas being brought in, or allowing kind of foreign students back into the country, or even softening some of the immigration requests. That's that volatility that keeps turning around in the last couple of weeks.
Yeah, it's really interesting how the trade narrative is very much feeding itself, dovetailing into some of the domestic agenda items that the Trump administration is dealing with. Let's talk about what's been going on with oil, Kriti, because we mentioned in our headlines we saw a big spike yesterday in trading, and we're still up at elevated levels as a result of that, up by more than 5% in session during yesterday. And then again, in the early hours of today, we were up in the Asia session by more than 1.5%. Again, we've seen the oil price retreat just a little on those trade news lines. But really, the story around oil is that the US is ordering some of its staff from its embassy in Baghdad to leave. And Iraq, of course, is the OPEC second largest producer. And all of this after we've heard from Iran saying that they will retaliate against US infrastructure if they are attacked, if there is a failure to make progress on the nuclear agenda around Iran. And President Trump has not sounded hopeful on what they can achieve quickly around Iran. So there does seem to be a lot of nervousness and tension in the region. We've seen the UK Navy sending out an alert around high tensions in the Straits of Hormuz. So a lot of people focused on that region, and oil prices in the past 24 hours have certainly been focused on that region.
It's fascinating because even with that kind of geopolitical risk there, the oil price, you can see it on your chart there, higher, getting to a $70 a barrel mark. But then you fold in the the trade tensions, and you have an opposite kind of downward pressure as well. So the oil market is going back and forth. Other outlets suggesting that the talks around, as you had mentioned, around nuclear energy have come to a standstill between the United States and Iran, and that some sort of retaliation from, or some sort of larger scale attack from Israel may be due in that region. Again, from several other outlets, not confirmed by Bloomberg, but certainly something that is feeding into this market narrative. And I'm curious in the days ahead, what moves the market more, the geopolitical tensions in the Middle East or the trade tensions that are kind of overshadowing this entire market?
And it was interesting, during all of the data we saw yesterday hitting the market, thinking of CPI in particular, and moving on to our next agenda item, it was interesting that the role that Treasuries were playing and the role that Treasuries continue to play this morning, it seems we were pricing out, we were pricing in more Fed cuts yesterday on the back of that dovish CPI print out of the United States. And this morning I read about how Treasuries are being treated as a haven once again. And so it seems we're back to sort of, this is economics 101, I guess. We're back to where we started before all of the recent tensions at the long end of global bond markets. A lot of people asking questions about where we go in terms of that fiscal sustainability. But on the CPI front, then, we had this number coming in really pretty weak, 0.1% month on month, excluding food and energy. That's way below the estimate of 0.3%. And so the market very much focused on that. And now you can see on your screen, we've had data out from the UK as well. The UK economy shrinking by 0.3% in April, month on month. This is just 1 month worth of data, but it's a glimpse of the second quarter, a glimpse into the second quarter, because the first quarter was perhaps flattered by the global economy trying to get ahead of the tariff agenda, and now maybe we give some of that back in the second quarter, and hence some of the weakness.
It's fascinating, the fact that we're using both of these data sets, both the United States and the UK, as this kind of signal that there is a slowdown in the works, but it's perhaps not as dramatic as I think a lot of people were expecting, even just 4 weeks ago, or even on Liberation Day, where we were expecting to see a more pronounced tariff impact. And to your point, we did see that being front run. To me, in the CPI data yesterday, it was fascinating that you didn't actually see the inflation jumps that you would in certain products. It was actually the opposite. And it's been 2 months now since... about 2 months, I think, since Liberation Day. So that shows up as well. But the UK, I think, is interesting as well, because we are still seeing that the UK has carve-outs. The UK has a little bit of a different reaction function to the tariff agenda than, say, the EU, China, Japan, etc.
Yeah, absolutely. And Howard Lutnick here yesterday talking to the Prime Minister, confirming that they would act upon the framework that has been agreed between the US and the UK. Yeah, we spent a lot of time yesterday, Kriti, talking about the extent to which we were going to see that pass-through of tariffs in the US CPI print. And we didn't see very much of it, did we? But again, we were only at 10% base levels rather than those elevated nation-specific Liberation Day, to put it in quote marks, tariffs that we'd seen imposed by the Trump administration. Many of those rolled back or given a stay for 90 days, of course, until July 9th. So we maybe had too high expectations if we thought that inflation pass-through was going to happen in yesterday's print.
Yeah, it's fascinating. And do we need a couple more data prints to show that? Because we've been saying the same thing for things like payrolls data or jobs data, not even just in the U.S., but here in the UK and in Europe as well. We're expecting wage growth, for example, or the wage numbers to show up in a more pronounced way. And we haven't seen that read through yet. So maybe another month or so.
OK, we will let the data settle. Let us tell you what is coming up in the programme in terms of our conversations with guests. David Reeves from Schroders, Global Economics Head, will be with us. We'll certainly be talking about debt sustainability in the US context there. Virginie Maisonneuve, Allianz Global CIO for Equities. What do we think? What should we think about US tech at this point as we think about the ways in which the US is still exceptional or not? Mel Stride will be with us, UK Shadow Chancellor from the Conservative Party. So we'll certainly be getting into a conversation about the UK and investment there. And we will also have a panel focusing on the future of the US with co-heads of investment at JPMorgan Private Bank, Grace Peters and Stephen Parker. So we'll talk US, rest of world, Kriti, where the flows are, what the conversations with clients look like right now.
Yeah, looking forward to seeing if they're having the same experience on both sides of the Atlantic. We'll certainly see that. Plenty of data ahead and plenty of events ahead as well to mark your agenda with. We do have the NATO Secretary General Mark Rutte arriving in Rome to meet with Italian Prime Minister Giorgia Meloni. This, of course, ahead of the NATO summit, I believe, next week coming up as well. So that's going to be crucial in terms of getting that defense spending and getting the Italians on board with the NATO plan. And then, of course, the focus does shift back to the U.S. when it comes to that data deluge. U.S. PPI numbers, jobless claims due at about 1:30 UK time. Plus, Scott Bessent, some testimony in the Senate Finance Committee. Let's see what he has to say on the latest in terms of that tariff story. And then, of course, a test on whether people want exposure to the long end of the curve, a 30-year bond auction, which we know has already been a little bit of a scary place to operate if you're a bond market investor, but
yes.
Here we are.
The last few days, though, we haven't been in that scary place, have we? We haven't been worried about debt sustainability and the long end of global bond markets. We've been thinking more about the weakness in data, the weakness, at least versus estimates, of the US jobs print, of the CPI print, and that's got Treasury markets looking a little bit different. We're not quite at the coalface of those conversations about higher yields and how high those yields go and that sort of scary territory. Interesting that we get Scott Bessent talking again today. He was already, of course, on the Hill. He was saying that it remains to be seen whether the tax bill will add to debt. I suppose even if you're Treasury Secretary, there are things you cannot see. And we'll see what is agreed around the big, beautiful bill, which bits of it survive, whether some of the revenue-raising measures, in particular around the rest of the world, Section 899 and tariffs, whether they stay in place and enabling some of the tax cuts.
Yeah, at the end of the day, if you want to balance the books, you kind of need that tariff revenue. So does that erode into the value of these trade discussions? In the meantime, these markets, we've seen continued dollar weakness. That has been a theme across the board. But the 10-year remains fairly range-bound. Since Liberation Day, again, April 2nd, you do have a range of somewhere between 420 to 460 on the U.S. 10-year. And it stayed there despite all the trade headlines.
Yeah, so we'll see if that auction brings anything different today. Let us tell you about some of the other stories you need to know this morning. We start with European politics. Prime Minister Donald Tusk's government has survived a vote of confidence in the Polish parliament. Tusk called the vote following the defeat of his political ally in the recent presidential election. The presidential victory of Karol Nawrocki has raised concerns about continued political gridlock, with the government and presidency at odds. But surviving the confidence vote is seen as a key boost for Donald Tusk's coalition. The Trump administration has launched a review of the Biden-era Aukus military pact with Australia and the UK. The Pentagon says it will study whether the deal aligns with Trump's America First agenda as it shifts the burden for collective defense to its allies. The 2021 deal involves the US selling Australia up to 5 Virginia-class nuclear submarines as the allies develop a next-generation vessel. And protests against immigration raids that began in Los Angeles have spread to other cities, including New York, Chicago and Milwaukee, with some clashes reported between protesters and police. In LA, the downtown area is set to be under curfew for a second night. Tensions remain high, with California Governor Gavin Newsom using a TV address to call President Trump's use of federal powers an assault on democracy.
Coming up on the program, DoubleLine Capital's Jeffrey Gundlach telling us a reckoning is coming when it comes to U.S. debt. We'll have highlights from that exclusive conversation. Plus, live coverage from our very own Tom McKenzie. He is at the Founders Forum. Stay tuned for a conversation with Robert Lacher, the Visionaries Club founding partner. But up next, right back to the markets. Traders awaiting that 30-year U.S. auction later today. More on the fresh test of demand for the long end of the curve. If you have any questions of your own for our guests or for us, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
But are you short the dollar? I mean, you mentioned you're into yields.
I would say that the easiest long-term trades are, the yield curve's going to steepen probably to historic wides. We're going to cut short-term rates dramatically in the next year. And the dollar will probably be lower because of that. A lot lower because of that.
How much lower? We're off 10% from our high right now. 8%.
Yeah, I would say I think that's a year from today. That's probably a realistic assumption.
If you're looking for any sort of bullishness on the dollar, do not go to Paul Tudor Jones, of course, the Tudor Investment founder there, in an exclusive interview with Bloomberg and our colleagues in the United States. Let's bring in Bloomberg's Valerie Teitel. Val, walk us through the story.
Extraordinary interview with Paul Tudor Jones. I urge everyone to watch that YouTube clip. It's 25 minutes long, but I spent all 25 minutes watching it this morning, painting quite a dire picture of financial repression, talking about how the Trump administration is going to pick a uber dovish Fed chair who's going to slash front end interest rates in order to help the government fund itself, which would lead to historically steep curves and a dollar weakening by 10% off the back of that. Really interesting call from Paul Tudor Jones, but it's gotten a lot of people talking about what is going to be this next Fed chair pick. And if it's not going to be as independent as we hope, are we headed towards a perhaps extraordinary Fed moves May 2026 when the new Fed chair comes into play? So Treasury yields, very interesting to watch off the back of that kind of interview. I also keep my eye on the U.S. dollar. The Bloomberg Dollar Spot Index is hovering around year-to-date lows. We've got euro dollar through 115, less than 40 basis points away from year-to-date highs for euro dollar. Really, it goes to show that whenever we get negative news on trade, we see the dollar weakening. That is a continued trend that we continue to see at this latest tariff threat from Donald Trump. I do want to note one more thing here, Anna and Kriti, about this CPI print yesterday. I really think is going to have economists really start to rethink what kind of tariff pass-through we're going to get in CPI. Because if anything, yesterday's data showed the exact opposite. All these components that we were worried would give us some hints about tariff-induced inflation showed the exact opposite, showed deflation in yesterday's print.
Valerie, thank you very much. Bloomberg's Valerie Teitel, from financial repression to the latest CPI data, setting up nicely our next conversation with David Reeves, head of global economics at Schroders. David, nice to have you with us. Thanks for joining us around the desk today. Let's start with US debt sustainability, shall we, then, because Valerie talking there about some of the concerns that we've heard from various quarters about that and on that front. How concerned are you about the United States? What worries you most?
Yeah, I think debt sustainability is a big issue, actually. There's been a hell of a lot of focus on tariffs. Everyone's been worried about tariffs. We see it in our investor surveys. But actually, to me, fiscal is the bigger issue because we know the US debt and deficit situation is bad. We see that the Trump government is trying to push through a kind of package. Now, the package in itself, it doesn't pertain to a massive loosening compared to where we've been, so there's not a big fiscal impulse. But we don't know exactly how it's going to work through the Senate, and clearly debt is going to be marching higher. Appetite for US assets seems to have waned a little bit. There's scope for term premiums to keep rising, pushing yields up and dragging the whole global yield complex up with it.
Yes, I was going to ask you about the global read across, the global implications, because you say in your research that this is increasingly a developed market, not an emerging market problem. And that's quite a change, isn't it, from some 10 years ago, a new era for the global economy?
Absolutely. So typically when we've seen Treasury yields rising, that's often caught out emerging markets with dollar debt, fixed exchange rates, etc. All of those kind of fundamentals in the emerging world are improved. And we're not talking about a kind of old-fashioned debt default crisis. But what we do see in the work we've done, we've put a kind of scorecard together looking at fundamentals, things like twin deficits, growth versus interest rates, net international investment positions, etc. And what you see is that actually the fundamentals, sovereign fundamentals, are quite weak in a number of developed markets. Call out the UK and I'll call out the France's too. What you've seen now also is that long-term interest rates in those countries have become pretty well correlated with treasuries. And if treasuries are marching higher because of what's going on in the US, that could drag yields up in these other markets and weed out a few of the weaker sovereigns. And we keep seeing it with the UK. Every time yields go up, Rachel Reeves has got to do something because her fiscal headroom is eliminated. And that's probably going to be the pattern.
Well, speaking of, we are getting headlines that are crossing the terminal, kind of diving into the data we broke at the top of the hour, talking about that the UK goods exports to the United States in April fell the most on record, that according to the ONS. But I'm still waiting for the bigger ripple effect when it comes to this tariff story into the UK, but into the rest of the world as well. You look at the hard data, and outside of shipping data, it's not really showing up. When does it show up?
Well, and actually the shipping data, if you look at that in aggregate, you don't really see that much impact whatsoever. You see it in kind of China to US direct. But we put a lot of kind of emphasis in our work. I guess at the start of the year, we made some key assumptions. One, that tariffs would be not too high, so kind of 10% on the world and a higher number on China of 20, 30, 40%. But also that you get some rerouting of trade, which would then circumvent some of these barriers, and that all of that would ultimately be fairly manageable. And, you know, famous last words of all the negotiations that are going on, but it feels like that's kind of where we're settling. And so if that's the case, and if US consumption doesn't fall off the cliff, then you'll see some softness in the trade there, but I don't think you're going to see it collapse outright.
Is there we talk a lot about how the markets like clarity, that the volatility is almost kind of half the step to take. Is this a global economy right now that can work it through the volatility or can work through a say, 50% tariff rate on the EU, for example, or some of these high numbers? Or is the volatility the bigger poison pill here?
Well, if we get some numbers on tariffs like that, then that is a different dynamic. That is causing much more economic damage, both in the US with inflation. That would ultimately come through in inflation, but also weaker growth in Europe. So that's a kind of big risk scenario that we talk about in our kind of when we do our scenario analysis. But in general, I think the uncertainty is clearly an issue. We assume that it's going to be a kind of slow burn drag on things like CapEx, because if you just don't know what's going on, you're going to mothball, you're going to slow down investment processes. We don't think it's going to run off a cliff like the way that sort of CEO surveys would say it's going to -10 tomorrow. I don't think that's really the case. But there's going to be a slow burn drag on CapEx going forward until we know exactly what's going on.
David, can I take us back to the US and thinking there about the other side of the twin deficit story? So we talk a lot about the US's vulnerabilities and the twin deficit, something the administration is clearly trying to tackle with some of its policies. The other side of that, though, is that you rely on foreign capital coming in. Do we have a sense of how that dynamic is developing and how that might become something that the White House needs to react to?
Yeah, I mean, potentially. So when we talk to our clients at our investor survey that's come out today, we see that, you know, 2/3 of them are worried about tariffs and they want to be more active. 80% of them want to be more active in the way they manage their investments. And we've definitely seen much more interest in places like Europe, etc. This kind of idea that people want to diversify and broaden out their exposures a little bit geographically. And that plays into this idea of the marginal bid for US-denominated or US assets being a little bit softer at a time when you've got these twin deficits. And if that's the case, that there's a little bit less appetite to buy those assets, then the natural sort of flow would be that the dollar starts to depreciate and roll over.
And the administration might like some of that dollar weakness, but are there dynamics they start to not like?
Well, they won't like the fact that long-term yields are going up as a consequence, right? Because the way to correct that supply-demand imbalance in the Treasury market is through pricing and higher yields, and that obviously runs completely counter to what they want.
How much of that kind of higher yield dynamic is doing perhaps some of the hawkish work for the Federal Reserve and other central banks around the world that are worried about inflation?
Yeah, I mean, it tightens financial conditions pretty quickly, right? And that's something we've seen. It's been a feature over the last couple of years where financial conditions have tightened and loosened and driven growth even when policymakers have stood pat. So it does help to tighten conditions a little bit, to take a little bit of steam out of the economy. But, of course, then if you get blindsided by a big tariff hit or something, then that's not ideal.
If Jay Powell is replaced next year, how much of a concern is that?
Yeah, it's add it to your list of unknowns.
A long list.
A long list of unknowns. And it's certainly something that we've been debating a lot, because if you get a dovish stooge put in place who starts cutting rates, even if the fundamentals of the economy don't justify it at the time, then what's that going to do? Well, it's going to fuel this kind of negative story on the dollar, this negative story on long-term yields. So, yeah, that is a concern. How do you actually start to price that now is very difficult. But again, I think it feeds into this kind of rising term premium and kind of turning the dollar type story.
Well, in case we were worried, 2026 is promising to be an exciting year already. David Reeves, Global Economics Head over at Schroders, joining us around the table to talk about a little bit of that U.S. story and the ripple effects around the world. Coming up, we're going to head to the Founders Forum in Oxfordshire. We'll speak to the founder of early-stage venture capital fund Visionaries Club, Tom McKenzie, on the ground with us with an all-star lineup. That conversation next. This is Bloomberg.
Welcome back. This is the opening trade. It is Thursday, the 12th of June, and the picture for the start of the European equity session looks a little bit negative, in fact. Down by 0.8% on Euro Stoxx 50 futures, so more than a little bit in some of these markets. We'll keep an eye on what's happening with commodities. We've been led higher and then a little bit lower on the oil price, and we'll see if that spills over into European markets. That's going to be something we're watching. But US futures also pointing Kriti a little bit lower, down by 0.3%, so a little bit less there. It seems that the tariff headlines from President Trump talking about imposing his tariffs on the rest of the world, essentially, and he's going to put out letters to that effect in the next couple of weeks. That seems to be taking the edge off risk.
Absolutely. A more pronounced reaction in the equity market, perhaps not as pronounced in the bond market, especially when you are seeing marginal moves. Of course, a risk-off sentiment, so you are seeing a little bit of downward pressure on yields. But again, not a massive bid going in. We'll see if that changes perhaps as the gilts open in about 30 minutes time when you see a little bit more volume hit this market. In the meantime, the Founders Forum Global is running in Oxfordshire today, featuring over 200 unicorn founders alongside VCs and leading startup and tech figures. So what do? We send Bloomberg's Tom McKenzie there with a special guest. Tom.
Kriti, thank you very much indeed. And yes, good morning from Oxfordshire. Very pleased to say I'm joined now by Rob Lacher, who is founding partner of Visionaries Club, which is a VC group which brings together a really interesting group of entrepreneurs and founders with scar tissue. They built business, you and the team, but you also bring together some of those older family businesses and enterprises in Europe, the likes of Henkel and Siemens as well, coming together to invest in startups like Lovable, like Pigment, some really red-hot startups here in Europe. Rob, thanks for your time this morning. What is top of mind for you and your colleagues within the ecosystem at Founders Forum this week, as we hear from Jensen Huang of NVIDIA saying there needs to be more infrastructure built in order to build the AI innovations for Europe? What is top of mind for you, your team, and your counterparts here?
To be honest, top of mind is really feeling an energy that we didn't have in Europe since I'm alive. I think this geopolitical shift right now, as bad as it is, but for tech, it's the best thing actually that could happen to Europe, because people are hungry again, people take risks again. We have really young people that want to start companies and that are hungry again, really to build. And this is something I think right now everyone feels that we didn't have in the last 20 years. People start being bold again. We want to be more independent again. We stop sleepwalking a little bit what we did the last 20 years. And I think if we look at how fast AI is happening, we really need these hungry people like Lovable. Anton, you mentioned, who was starting it out of Stockholm, just launched 6 months ago, and now it's at 60 million revenue. So it's one of the fastest growing companies globally. So that's really what is making us excited.
So
these
geopolitics
days
has been a catalyst.
Yeah.
What are you and the team leaning into? Is it AI? Is it defense? Is it healthcare?
Yeah.
Is it across that spectrum? What for you is the key opportunity right now?
I think right now AI and defense are for us the most interesting sectors that we invest in. So on the AI side, we're going away from having a hypothesis of what we want to do, because the minute you do this, it's basically outdated. So we're really going back to radical founder focus, trying to back the absolute most talented people that have an idea at the earliest stages, because it's just the minute you're trying to have a hypothesis yourself, it's just getting outdated. And the disruption in AI is so much faster than it has been with cloud or software. To just give you an example, when we invested into a software company in 2016, the best companies took 4 years to go from 0 to 10 million revenue. In 2019, we invested in Deal, which was back then the fastest growing software company. It took 2 years to go from 0 to 10 million ARR. If you look at Lovable, it took basically 2 weeks. So I think what we're seeing is a speed of disruption across all areas of economy that we haven't seen before. So that makes us excited, but also makes it difficult to keep up with the pace, which topics, which sectors you want to invest. We basically focus more on the founders and let them impress us with the ideas. Defense is something incredibly exciting for Europe, because it's a sector where we have a lot of strength actually in the past that we can leverage in terms of hardware technologies. Defense is not just software, it's not just AI. 80-90% is still an incredibly strong hardware that needs to interact with the software.
Do we have the capital needed, the patient capital, to invest and build out that deep tech that is so important to defense?
Yeah. I think yes. I think we even have an advantage in Europe, because if we look at the people investing into defense, you mentioned that Visionaries, our LP base, are a lot of the family entrepreneurs that have built the industrial leaders of the past. Many of them are defense leaders like Lürsen, the shipyard company. And if you look in Germany, companies like Deal, KNDS, in France, Dassault, they are family businesses. So they can take risks. They are still pretty profitable, and they can think very long term. And this is the patient capital that we're navigating into defense companies right now. And founders are, it's interesting that for a defense founder, venture capital is not always the first most sexy investor, because these people are momentum driven, fast exit. Some of these defense founders that we work with, we are really more interested in connecting with this industrial economy syndicates.
Talking of funding, Jensen Huang in Europe making the pitch, a sales pitch essentially saying, build out the infrastructure, build out the data centers, tens of billions of dollars could be lined up for data centers in continental Europe, possibly here in the UK as well. Is that the right allocation of capital? If Europe can win on the application layer of AI, should we be investing capital in those data centers, in that hardware?
I think it's not either or, it's both. I think we need to be independent on the infrastructure as good as we can, but we also need to be honest where we can be independent. So we have companies like ASML who are kind of the ultimate source of building chips and enabling NVIDIA to build the chips that they're doing. But we're of course behind, we don't have NVIDIA in Europe, but we need to get our own infrastructure here. So it's important that we don't do the same mistake that we did military-wise in the last 50 years to make us 100% dependent on the US, also on the economy side. So I think the infrastructure layer is important. If you ask me about the opportunity that I mainly see and where we invest, it's the application layer, because I always compare it a little bit with the iPhone moment or the mobile revolution where, Apple and Google are the main systems. And they're kind of what you could compare on the AI side with foundational model players. But I think 98% of the revenues in mobile are done by applications that are sitting on top of Apple and Google, whether it's, that Uber that you use and all these companies. And I think we're now getting into the application layer stage of AI where, just take Lovable, all these companies that I just mentioned, they are growing so fast. They're not the OpenAI companies. They're the companies sitting on top of it. So I like
that analogy. It makes it very clear, doesn't it?
That's an incredible potential.
Before I let you go, what is the fundraising environment looking like right now for you and the venture capital? Is that deep freeze around funding starting to ease? Is it becoming slightly easier to raise capital?
So we're in the lucky position that we don't need to raise. So we're in the deployment stage. Yep. I think for founders, there's more than enough capital right now. So maybe even too much at the later stage for software. For VC funds, it's a difficult situation, I think, because there hasn't been a lot of DPI in the last 5 years. And there has been this bubble period that was kind of bursting 2 years ago. So I think there's a mixed sentiment on the LP side because many haven't gotten a lot of DPI and then need to see how they
the liquidity constraints.
Exactly.
So they haven't had that capital return.
Exactly. So again, we have to be careful in Europe that we don't get eaten up by the US because luckily we have programs like the European Investment Fund. We need to get our family entrepreneurs. We have so much fortune, so much net worth in Europe that we can deploy into the future of tech. We just need to get these people deploying it here so that we have the local capital available as well and not just the US funds backing our early stage startups.
Okay, Rob, fantastic conversation. Rob Lacher, thank you very much indeed. The founding partner of Visionaries Club, backing businesses like Pigment, like Lovable, like Vey, really hot startups here in the European ecosystem. Joining us, of course, at Founders Forum here in Oxfordshire. Guys.
Tom, thank you very much. Tom Mackenzie from the Founders Forum in Oxfordshire. We will have more from that event, of course, throughout the day. Tom will be speaking with BYD's Executive Vice President, the CEO and co-founder of the AI firm Synthesia, as well as Balderton Capital's managing partner. And if you're watching from Founders Forum, or if you are just in any way interested in all of these tech conversations, then you really should know that we are starting a new Bloomberg Tech Europe show that's going to be hosted by Tom. It's a monthly show. It starts tomorrow at 6:30 a.m. London time.
Very exciting stuff. I've got a preview of the guest lineup. It should be one not to miss. Coming up on the program, though, another interview not to miss with the Czech president saying Europe must take greater responsibility for its own defense as the continent looks to transition away from the United States. An exclusive conversation with the president, Petr Pavel, coming up next. This is Bloomberg. The president of the Czech Republic says European leaders need to preserve unity at the upcoming NATO summit in order to keep their American allies engaged in Europe. Now, in an exclusive interview, Petr Pavel explaining the timeline and what he expects next from the transatlantic relationship. Take a listen to part of our conversation.
Right now, I believe there are two major avenues how to push Russia to the table. One is obviously on the battlefield, supporting Ukraine militarily and financially to hold the territory and hold defense strong, to create conditions for peace negotiations that will be favorable for Ukraine. And on the other hand, and it's even stronger in my view, it's economic and financial pressure on Russia to sit to the table. Because right now they are not showing any willingness to negotiate the peace, because they still see that they can prevail.
In the interim, there's been a big conversation, of course, about defense spending and ramping it up across the European continent, perhaps creating or filling some of the gap that the United States has pulled out of or is attempting to pull out of when it comes to NATO spending. I am curious, though, of how long that process will take. A defense ramp up, as you know from your former perch at NATO, can take years. What can the EU and NATO do within the next couple of months to affect the outcome?
Well, first, we will have to preserve unity at NATO summit in The Hague in a couple of weeks, to keep American allies engaged in Europe, both politically and militarily. And we all understand that European allies will have to take a much greater responsibility for our own defense. But this transition, this handover of responsibility from the United States more to Europeans will require some time. And even if we adopt the decision to increase significantly defense spending, even if we apply all the measures of flexibility and efficiency, it will really take years to replace some of U.S. strategic enablers, such as strategic intelligence, communications, logistics, and some others. And of course, if we don't want any security gap to be created in Europe, we will have to seriously negotiate with our American allies about a good transition plan. What is realistic to achieve? I understand that the United States will try to exert pressure on Europeans to do it faster. But even if we do our best, we will not be able to do it in just a couple of months or just units of years. Some, like strategic intelligence and targeting, may easily take a decade to achieve that capability. But I truly believe that we can achieve good results if we have a good and coordinated plan.
A final question to you, as you say that you will be attending that NATO summit. There are reports that Donald Trump will be attending as well. What do you expect to hear from the President of the United States?
I expect a continuation of his approach from his first term, which I witnessed in person. And it's even stronger now during his second term. He will be pushing on European allies and also on Canada to do more and faster. So we can expect the push for commitment to defense spending at 5%. We can expect some short timelines for taking over this responsibility. We can also expect more commitments from European allies in terms of support to Ukraine. But I personally don't expect any negative surprise, because I believe that the agenda of the summit is deliberately kept to, I'd say, minimum extent, so that we have an agreement. And that's why I believe that this summit will reiterate the unity of NATO, commitment of the United States to Article 5, and commitment of all of us to increase defense spending and our overall capability for defense.
The Czech Republic President Petr Pavel speaking exclusively to me over in Prague. And it was a fascinating conversation because not only is he the Czech president, but he's also the former head of command in NATO. So he has a very real understanding of how long that defense ramp up takes. He's talking about a decade there. And he's saying the grace that they need, that Europe needs from the U.S. is just a little bit more time to make that transition. That's not something that he thinks Donald Trump will do in the next couple of months. The other conversation, of course, he's having domestically has a lot to do with the currency and the euro. The Czech Republic does not use the euro at the moment, but a lot of their businesses, a lot of their labor is ultimately paid in euros. He's trying to sway public opinion to get more of that adoption story, which is facing some very real populist pushback as well. But he makes the case that right now, when the euro is so strong, we're looking at a 115 handle right now. Why not, if not now? So that's a domestic conversation he's also balancing.
Yeah, other parts of Eastern Europe are more imminently dealing with the euro coming. Bulgaria, for example, that's the focus of some of our reporting this morning. And the popularity of that move in some places and lack of it in others. Let's talk about the euro and the other side in euro-dollar. Markets Live Executive Editor Mark Cudmore joins us for 3 minutes on the markets. Mark, we talk a lot about weakness in the dollar, and weakness in the dollar continues to be a feature this morning. We've seen moves into the yen, of course, overnight. The euro a little bit stronger on the back of that. This to do with the latest trade headlines. How much further do you think euro strength has to go?
So 2 time spans. One is there's the longer term story where I think that euro dollar is going to go an awful lot higher. As I always say in this program, 130 before 106 is my updated kind of metrics. That story is about diversification away from the dollar. Again, it's not about an abandonment of the dollar. It's just about reducing exposure. Dollar will remain the world's reserve currency, but euro is like one of the most viable alternatives if you want to increase your diversification. It's not about a particularly aggressive euro story. There is a positive euro story in isolation from the dollar, but it's not enough to drive it that far. This will be an overshoot from euro terms and might cause the continent some problems, but it's going to happen because of dollar weakness. In the shorter term, I don't really have any particular conviction, but my view is that the dollar has been depreciating for the last 5-6 months. And until at some point there's going to be a material squeeze, a short squeeze, it'll only be a temporary one because the structural trade is true. But until we start seeing signs of that squeeze, I don't know why you'd get bullish. So, you know, the structural trade is short dollar. You've got to be bearish dollar until you've got a reason for a squeeze. I don't see it on the horizon just yet.
Talk to us a little bit about the disconnect, perhaps, of what we're seeing from the bond market versus the currency markets. Mark, I'm looking at a range here, basically of 420 to 460 on the U.S. 10-year, despite the fact that the dollar continues to weaken. When does the bond market and the FX market start to move in tandem again?
Yeah, I think that, look, the dollar trade has many different tangents to it. The world's overexposed to U.S. stocks. They significantly want to reduce that over time. They also have exposure to the US that's unhedged. They bought it because of the dollar smile. So when there was risk-averse periods, people went back to the dollar. That's now changing a little bit. In fact, my colleagues in New York have referred to it as a dollar frown recently, which may only be temporary. But the fact is, there are people, even if they're keeping their dollar US exposure to assets, then they want to hedge that a little bit more on the currency side. And then finally, there's the Treasuries trade. And again, there's no reason to panic about US Treasuries in the short term, even if you're quite worried about the direction over the next couple of years, like I am. Short term, there's absolutely no reason to get bearish right now, which is why I think that all these trades work at different time spans. But overall, the dollar trade remains very strong. And the disconnect is not alarming at all between Treasuries and the dollar just now.
OK, and Mark, what did you make of the inflation print we got out of the United States yesterday, waiting for data to break in one direction or another, and we seem to keep on waiting?
Yeah, I think probably the main takeaway is that this might be the tariff impact for now might be more of a growth impact than an inflation impact. We saw deflationary in some of the services components outweigh what we've seen in goods components, which is quite interesting. What it also says is companies are absorbing the cost. So that's not great for shares. So I think ultimately the biggest takeaway from this CPI print is probably negative for stocks, even though we haven't seen that play out yet.
Interesting to see how it will. Bloomberg Markets Live Executive Editor Mark Cudmore joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So Tesco's numbers looking pretty strong today. They're reporting a 5% gain in their like-for-like sales in the last quarter. That's actually around a full percentage point above what analysts were looking for in the last period. Potentially this is going to be reassuring because we did see a big drop down in Tesco and the other supermarket chains in London when we got a profit warning out of Asda a couple of months ago. We have kind of recovered since then, but there's a lot of uncertainty around competition in the space and discounting as well. So as I say. Possibly reassuring for Tesco today. Then we've also got Prosus, the big tech investor listed over in Amsterdam, projecting that their sales or their revenue could double in the following years in terms of reaching that bigger target that they had set at a previous event. Now, we can see this one has been a bit of an underperformer over the past few years. On the orange line here, we have the stock, and there's the tech index in Europe. So we can see potentially we might see a bit of a boost or a bit of a pairing of that underperformance. Tencent is their big holding over in China, and the company has seemingly benefited from that investment in the past quarter. Then we've got BE Semi. This potentially going to be the biggest move we've got today. It's up around 10% on the Tradegate exchange today. The firm is boosting its outlook for revenue. This is the chip machinery company, also listed over in Amsterdam, kind of in the same bucket as ASML, but saying they're doing really well in some of their newest contracts. So we can see it's another stock that's not done very well over the past year, but potentially BE Semi going to be a big gainer, as I say, up around 10% on Tradegate this morning.
Joe, thank you very much. Equities reporter Joe Easton. And we'll add to the list another one I know that's on Joe's radar, that's SAP. Kriti, we'll watch these European software companies. We saw in the United States Oracle jumping after they put out an update projecting a surge in cloud infrastructure sales. And, of course, Oracle, SAP compete in that enterprise software space. So we'll watch that. More broadly, though, quite a lot of weakness in European futures.
Quite a lot of weakness, 100%. We'll see, though, if that positivity that you talk about is actually maybe combating some of the weakness. Is there a lesser drop in some of those tech spaces? All of those questions answered in about 5 minutes' time. Stick with us. This is Bloomberg.
This is the opening trade. A few minutes to go until we get that opening trade then for this Thursday morning. Let's remind ourselves of yesterday's session and how it sets us up for today in terms of the handover into Europe from the United States. So this is the picture on European markets yesterday, pre the US opening. We got that boost as we saw that pretty benign CPI print coming in. That allowed yields to come a little bit lower and we saw stocks go higher. Then into the US session, you can see that Europe retreated a little bit and really some of the moves were echoed over in the United States. We didn't get a huge amount of handover from the US session then into Europe, even though things were a little bit weaker. But let's have a look at the European futures picture, and you'll see there's quite a lot of weakness in Germany. And I wonder if this is to do with the trade narrative, because we've heard from President Trump that he wants to send out letters to those countries he doesn't believe are making enough progress quickly enough on the trade conversations with the United States and set tariff rates, Kriti. That, along with the comments from Howard Lutnick talking about how Europe, the EU, might be at the back of the line, back of the queue when it comes to doing those trade conversations. I wonder if all of that is going to weigh on sentiment for German exporters. And we see DAX futures down by 0.8%.
Risk sentiment weaker across the board, as you say, and a couple of individual stories as well to flag for our global audience ahead of this open. We'll start with Tesco right here in the UK. They came out with a sales beat, looking at a 5.1% growth story. That's a pretty good number for Tesco as well. Plenty of tech names, I should say, as well, that are dominating the headlines this morning. BE Semiconductors, clearly one of them, quoted 9% higher on Tradegate. They're talking about a long-term sales outlook that may be impressing investors. We'll see if the market digests it in the same way. And Barclays is actually downgrading the European insurance sector. We'll see what the read-through is at the open, Anna.
OK, so we'll look for weakness at the start of the European trading day. US futures also pointing lower on those same trade headlines, that trade narrative, looking a little bit risk-off right now, but not to the extent that we're expecting to see it in Europe. So we'll see if we are indeed to see German stocks down by 0.8%, as futures had indicated they might be. Of course, the FTSE 100 often goes its own way, did so yesterday. We see it a little bit more resilient, perhaps, to the downside around trade, although we've already had news lines around trade and the impact of trade tariffs on the UK economy linked to April's GDP print. So perhaps we'll get to that conversation a little bit later. So the markets we have open right now are in negative territory, down by 0.5% on the CAC, down by 0.8% on the DAX. So there's that negativity. We'll see if it's concentrated around some of the exporting names, if it is that trade narrative that is weighing on things. We also have SAP to factor in, Kriti, and any read across from the Oracle numbers overnight. So we'll watch the tech names over in Germany as well. Broadly speaking, then, it does seem as if this trade narrative is something that weighs on sentiment.
Absolutely. I think we have a few answers already right from the get-go, which is a little bit unusual for the German index, where we do see it open. And a lot of this is, to your point, and actually coming from SAP, but perhaps in the opposite direction that we expected. We expected a positive read-through from Oracle. We're actually seeing the opposite. ASML, SAP, Schneider Electric, they're actually some of your biggest weights this morning when it comes to these markets. So you are seeing a very defensive tilt across the board. So bank stocks as well, some of those cyclically exposed names also taking a little bit of a beating. One bright spot, though, one spot in the green, and that, of course, is utilities. But that, of course, screams defensive, screams risk off.
Yeah, absolutely. Utilities going higher, energy going higher as well. So we see the likes of BP, Total, Shell, Eni, all moving higher. And that they're pretty heavily weighted, of course, on the markets they exist in, and partly reflecting that big move higher we saw in yesterday's session on oil prices, because we're down 0.8% on the oil price this morning, but we were up 5% in yesterday's session at one point. So there does seem as if we need to factor that into markets. But as you say, Kriti, those two sectors in positive really stand out as being exceptional. The rest of the market is pretty downward looking right now. Travel and leisure, actually, the worst performing sector. And that, again, might be a reflection of energy price moves. So when oil prices move sufficiently, that can become the only thing that matters to companies such as TUI, Lufthansa, EasyJet, Ryanair, all of those down by more than 1.5% in this morning's session.
Absolutely. You point to the Total story and the oil story there as well. There's another piece, especially for Total, that might be contributing to that heavy volume we're seeing to the upside. Some news this morning, a statement coming out. They are partnering with Mistral, which, of course, is the major European AI offering, perhaps, when they're talking about their innovation lab. So perhaps a little bit of an AI read-through into a sector that doesn't traditionally talk about AI. We're also, I should mention, getting a halting in shares when it comes to BE Semiconductor. So a lot of heavy volume there as well. We've got one eye on the energy space and one eye on the tech space, and one eye on the overlap as well. Joining us now to digest all of this news flow, Virginie Messenev, Global CIO Equity for O Equities at Allianz Global Investors. You picked a great day to join us because we don't really know what's happening, which I think feels like the norm now, in that we have so many of these trade headlines to digest, so much of geopolitical risk in various parts of the world. What do you do in an environment where you don't know what to do?
Well, I think you have to think that the markets have rebounded quite nicely since the lows of April, right? On the NASDAQ, we're up about 30%. Europe has done quite well. You've had the U.S. and China discussions, which were not bad, but they didn't come out with a big boom, right? 6 months rare earth, China wants 14 nano, and they probably got 28, or, you know. So you need a pause in the market. The market is absorbing this. At the same time, you've got oil prices flaring up, impact potentially on inflation, which is quite important, and geopolitics. So in that environment, I think you want to reassess all your holding. You want diversification. You want very strong portfolio construction. Maybe take a little bit of profits in names that have done really, really well, right? And just see what happens. I mean, really, that's the thing. I'm not seeing this as a major risk-off. But clearly, as we approach the July deadline on tariffs, there's a belief, I think, in the market that things will be extended. And it's possible that Mr. Trump tries to heighten the pressure because he is under a lot of pressure himself, right, in terms of his tax bill, etc.
I mean, to the point that he even, and we played this at the start of the show, was comparing the likes of his relationship with South Korea and Japan, which is supposed to be the bright spot in these trade arguments, to the likes of the EU. So to your point, the volatility story persists. You were often on our show, and we ask you what the pain trade is. I'm going to ask you what the opposite. What is the lazy trade in this market? What is the go-to sit back and watch trade in this market?
Well, I mean, for me, you still want to be in tech. So, you know, you have to be in tech if you look at how things are developing. So if you don't have enough and tech names come back, because generally they will come back if there's a risk off, you need to position yourself, right? Same for industrials. If you're not in China, you have to add to China if you have a risk off, right? We've done a bit of work around robots in China. It's actually quite amazing. You know, 50% of the world installed capacity, 2/3 of the patents, 66% of the humanoids, robots. Those are really interesting opportunities for the long term. And that's where you have to say, but diversification and portfolio construction is key.
Okay. diversification, portfolio construction, and humanoids. These are the messages I'm taking away from you, Virginie.
Not only humanoids, but if you have an opportunity to buy and you're not positioned enough in tech or industrials, you want to be
But this is important. I think it's interesting to think about tech from a number of angles because we are tackling the US exceptionalism story in lots of ways this morning. And one of those is around US technology.
Yes.
And how much is the China technology story eating into that US exceptionalism? I mean, that's a stretch when you look at NVIDIA. You know, that's still by far and away, you know, a standout performer. But how worried should US tech be about what we're seeing coming out of China?
So, you know, you have to think about what is US exceptionalism. Are we talking about the historical legacy, security umbrella, US dollar strong, US Treasury, everybody sells, trade deficit, people sell to the US, get US dollar, reinvest in US assets? Or are we talking about the exceptionalism of some companies, their mindset, their innovation, their risk-taking attitude, their ability to fail and pick up and go again, and which is an illustration of the tech sector. If you look at the pillars of the historical legacy of US exceptionalism, I think we see some cracks. Some of them self-induced because we are departing from the Second World War order, in that shifting world order. And the U.S. has domestic priorities that sometimes come in contradiction to this service, if you want, right? So I think that's one thing. But if you look at the tech sector, still very strong. But as a result of shifting world order, we have this bifurcation, China, US, or China, rest of the world, particularly in tech. So you see some innovation. And of course, in China, you have 18 million engineers, challenges in demographics. So you need that innovation. So there is competition, but there's still absolutely room for US tech names in the portfolio.
OK, so that's the tech conversation. Let me ask you about yields and how they play in here, because if we're changing the world order, we had a conversation last hour with our guest who was talking about how that means dollar weakness and that also means higher long-end yields in the United States. That might spread globally. Where does that are you playing that, is that steeper curve? I know that, equities are your focus, but is that steeper curve going to be something that damages the equity trade?
So shifting world order is a sliding path. It's not new. It's been going on for at least 10 years, right, as China ascended. The increase in yields in the U.S., in my view, is the response of very specific actions and uncertainties that are currently in the markets around new presidency, tax bill, deficits, where does it land? Where do tariffs land to pay for those changes and deregulation and tax bills? That, of course, has an impact on the world, but that's still very US specific. If you look at Europe, for example, we've got, sub 2% inflation, we've had cut-in rates, we've had, a very different environment. Now, if long bond rates were above 5% in the US for a long time, I think, which is not our central case, right? I think you could have that spread, but the US dollar and the US market is still very, very large. And it's not like everybody are going to sell all their assets overnight. So I think you're in that phase. Let's see where we are in 6 months. The economy will have slowed. The tax bill will be through. We'll know much more about tariffs, and let's see where yields are at that point in time.
Can you just connect the dots for us here about, we do see these jitters, of course, to Anna's point, in the bond market off of the deficit. But is that simply just a volatility of the bond story that then moves the equity market, or is there a fundamental case of how a deficit affects the corporation that we need to be thinking about?
So, yes, of course. And it affects it in the cost of capital. Right, because if you think of growth companies who finance themselves and who think very long-term, they have to think about long-term cost of capital. And if the long-term cost of capital is much higher, it will have an impact on how you finance your growth. Therefore, you need to demand for higher potential earnings from your investment in order to take into account that cost. So there is definitely an impact.
But does that impact is that impact cushioned, perhaps, if you see a more gradual move in yields?
Yes.
Or what are we worrying more about a more, quite literally, a cliff dive, basically, in yields?
Yeah. Gradual moves are always better for the equity market than sudden moves, except if sudden moves look like an aberration, a technical reaction, or where people say, let's keep things within a bigger framework and understand what is going on, right? That's the key.
Virginie, thank you very much. Thanks for joining us. Virginie Massenev, Global CIO for Equities at Allianz Global Investors. Let's visit the Core Six. Have a look at some of these key European mega names, if you like. Novo Nordisk, in fact, is all red. That tells you something, doesn't it? We're all red across these European equity markets this morning. Almost all sectors in negative territory. Only energy and utilities go higher, and they're not really reflected in this Core Six. So Novo Nordisk, LVMH, there we are. Nestle, a little bit of defensive pickup perhaps there, but Nestle is pretty flat this morning. Let's check in on some of the individual stock movers then. There are a few to choose from. Where do you want to start, Joe Easton?
So we'll start with BE Semiana, because that is really the big mover today. We were up around 10% at the open of trading, now up around 7.3% over in Amsterdam. Now, the company projecting that its revenue target could potentially hit 1.9 billion euros in terms of its medium-term annual goal. It previously estimated around $1 billion, so that was kind of the uplift in their forecast this morning. This coming from an investor day for the firm. It's the semiconductor machinery group, so a really big gain for that one. Coming down a little bit now, but still up 6.8% for BE Semi. Then in terms of the sectors, as Anna mentioned, energy really the strong spot today, given the gain in crude. Crude slightly lower this morning, but on a two-day basis, still up around 4%. So we're still seeing a boost coming through into BP, Total Energies, Shell as well. All of those stocks gaining more than 1% today. And then that feeding through as well into the airlines. The airlines significantly weaker. It does seem to be partly due to the oil price coming up, but also news on fares out of the US yesterday. Another drop down in airline fares, a third month of decline. So we saw United, American, all of those US listed stocks coming down. We're seeing that feeding through today into the European names. IAG, Lufthansa, Air France, all pretty much lower. Air France down 5%, a pretty big move in that one. Then finally on insurance, as Kriti flagged earlier, we did see Barclays downgrading its sector view on insurance. This is pretty much all due to valuation. It's the third best performing sector in Europe this year, and Barclays saying that the rally has gone too far. So they're cutting three key stocks today: Allianz, Swiss Re, Zurich, all downgraded. There are some actual insurance issues potentially related to natural catastrophe losses and property and casualty insurance. A little bit weaker as well, but it's mainly due to valuations and those insurance stocks falling in early European trade this morning.
Joe Easton from our equities team walking us through some of those early movers as we, of course, see a risk-off tone across the board. Coming up on the program, let's talk about perhaps different asset classes also dealing with that risk-off mood and some heightened tensions in the Middle East. Oil hit with volatility as those tensions rise over nuclear talks with Iran. We'll break down the latest headlines and what you need to know. Stick with us. This is Bloomberg.
Welcome back to the opening trade. 8:16 then here in London. So just 17, in fact, 17 minutes into our European trading day. And equity markets are weaker, with the exception of the FTSE 100, which is pretty flat. The DAX down by 0.7%. A host of factors taking us a little bit weaker over in Germany. The negativity overall perhaps can be attributed to the latest trade headlines coming from President Trump and Howard Lutnick. More specifically, what's more resilient this morning is energy stocks, and that is to do with the latest moves in energy prices. So oil prices in yesterday's session surged really strongly, up by 5% at one point. We didn't have time to factor all of that into our European trading day, and so perhaps we do a little bit more of that this morning. BP, as you see, up by 2%, and the rest of the sector pretty resilient, even though oil prices have retreated from those highs and are now down by around 0.9% on Brent. So we're at 69.16 on the Brent price. So with oil edging slightly lower, but after jumping more than 4% in yesterday's session, let's focus on the oil price. Traders are tracking rising tensions tensions in the Middle East and the latest moves in US trade policy, both of those pulling in different directions. Our Bloomberg Middle East energy markets reporter, Anthony de Paula, joins us now from Dubai. So, Anthony, take us through the factors that are driving the oil price right now. A big focus on politics and the potential for violence, I suppose, in the Middle East.
Yeah, and that out perfectly in terms of explaining the two factors that are really the push and the pull here, the trade on the one side and the geopolitics on the other. And if we look at that picture, it's really that risk of something happening in terms of the Middle East and in terms of an outbreak of potential violence in the Middle East between the U.S. and Iran, between Israel and Iran. That's really the risk that is pushing prices higher. We've seen also some positive news coming out in general about the U.S.-China talks, the fact that they think those talks went well and that they're progressing. Those are going to be bumpy as that goes along, but that then eases some of those concerns about the economy and that are weighing on the oil price as well. But then some of those negativities pull that back. But I think the real story here, even though we are seeing a little bit of weakness today in the oil price, the real story is that big jump that we saw yesterday. And even before going into yesterday, when there was about a 4% gain, we had seen a couple dollars more on the oil price since the start of last week. So we've really seen kind of a buildup as things looked more positive there in terms of oil. So I think really what is driving this is that those issues around the Iran talks, the fact that Donald Trump came out yesterday and said that the talks that he didn't think they were going very positively. A lot of that is a push and pull. We've seen this happen before, where Trump will come out and say that it's going well. The Iranians will come out and say that they haven't gotten what they want. We see this back and forth, but what is really driving that is that tangible concern, where we see the U.S. Potentially pulling out some non-essential personnel from the embassy in Baghdad, which shows a real threat there. We have also seen some warnings for vessels in the regions as well, which we know they have been under threat too. So we are seeing these real kind of tangible signs that people are getting concerned. So we think that's really what's inside that higher oil price at the moment, Anna and Kriti.
So, Anthony, this is the drivers to the upside of the oil price, as you mentioned. Talk to us about what may be weighing on the downside, because oil market traders also have to be thinking about what these trade talks actually mean. What is the more dominant factor for an oil watcher at the moment?
Yeah, again, right now it's that geopolitical risk of something that happens in the Middle East. And there is in the background that risk of economic tension, economic stress caused by a failure of the trade talks. So anytime that we hear something negative about some bumps in the road in the trade talks, which of course there will be, we're still in an environment where there's a massive amount of tariffs between the U.S. and China. Trump again is talking about coming in with the reciprocal tariffs and naming those amounts as we come to the end of that 90-day period. Bessent giving some more positive spin on that, saying that if countries are engaged, maybe they'll get another 90-day extension, but there's still a lot of uncertainty now. So that is kind of pulling on that. But I think one thing that the oil market is telling us as well, too, is that there is still that big concern about an interruption of supplies that could come out of a conflict with Iran. It's also showing us that at the moment, the market wasn't putting that much of a downside on Iran coming back, because as we were seeing the positive news up till now about how the talks have been going, we have seen oil kind of bottoming out between that 60-65 area. So that wasn't a huge leg down. And that comes as well with OPEC bringing lots of more oil into the market. So we are seeing that oil kind of holding up around that $60 a barrel mark up until now. We did report earlier this week that things are looking good in the market in terms of the fundamentals of the market, in terms of demand as we go into the summer. That could weaken going into the second half of the year. So we should see that drop. But we are seeing at the moment, with the fundamentals strong and with the up until now positivity about Iran, we'd seen oil kind of in that 60-65 range, so not hugely lower. Now we see that, of course, as there's concern that those talks might unravel coming up to the 70. And it'll really come down to if people think there's a risk to the supply coming out of the region. That's really what traders will be watching, Kriti.
Certainly something we're going to be keeping a very, very close eye on. Anthony DiPaolo, our Bloomberg Middle East energy markets reporter, walking us through the dynamics in the oil market. Let's take a hard pivot here and talk about the dynamics in one of the biggest retailers in the UK. Tesco shares on the move this morning after the company reported sales that beat estimates. Shares higher by about 1.4% in a fairly weaker broad market session. Charlie Wells is here with the latest. Charlie, walk us through these numbers.
Yeah, Kriti, so they had a beat on like-for-like sales, beating estimates, and a lot of this has to do with price. So Tesco, in a lot of ways, has kind of been meeting the consumer where they are, which is very price-sensitive at the moment. And, you know, it's an incredibly competitive market. Ken Murphy, the Tesco CEO, talked in the statement out this morning about that competitiveness in this market. So they've been aggressively trying to keep market share. Tesco is the largest grocer here in the country. But it's not just about price, too. They've made some strategic choices. So they rolled out about 350 own brand products in the quarter. And they also saw some of their higher end products, that Tesco Finest range, up about 18% in the quarter as well. So it's price, but it's also these sort of strategic moves as well that they've been taking that have helped them.
Yeah. And how is this particular retailer then? How does it set the tone for the rest of the sector?
One of the concerns earlier in this year was of a price war. And this is something, of course, that consumers love, investors hate, right? And we had all this news about Asda being back, about trying to kind of regain market share. Just last month, Asda was talking about discounting thousands of products. So there's concern that, you know, from the investor's perspective, this could launch that price war. We're not necessarily seeing that so much. And it seems like there's something of a floor on prices right now because of this other issue that we're seeing across the sector, which is increased costs that have come from the payroll taxes that we've seen under this new government, from minimum wage that we've also seen. So that's something that could actually kind of limit how far down prices could go in the sector. But it's still incredibly competitive, and we're seeing that in these numbers right now.
Is there a read-through here, or a takeaway, I should say, from how we should be interpreting the broader economy?
It's interesting, Kriti, because I think there's been a lot of messy data on the consumer, right? So on some hand, you know, last month you got consumer confidence ticking up just a little bit. And you could say, you know, perhaps that bodes well for a lot of these consumer companies. Maybe that's why we're seeing a little bit of uptick in Tesco. But then you get things like the GDP numbers looking bad this morning. And you could maybe take this as a read that, all right, well, sure, Tesco's doing great. They've beat, but it's Tesco, right? It's not Waitrose. It's not M&S. Maybe this is a sign that the consumer is trading down and benefiting some of these sorts of retailers that you start to see benefit in a downturn.
Yeah, we'll see if those figures out of the UK set the stage for a sort of tepid second quarter, or whether it was all about exports and that was really a sort of April story before the deal is enacted between the UK and the US. Thank you very much, Charlie. Charlie Wells with the latest on the UK retail space. Yeah, it is a really interesting dynamic that's happening in the UK, because you were asking earlier, one of our guests, you know, when do we see the effective tariffs come through in US CPI? It was elusive yesterday. We didn't really see it, did we? And partly that's because tariffs were not implemented to the full extent that everybody had feared. Partly maybe businesses just taking it on the margin and protecting consumers for a period. But the longer it goes on, the less businesses can protect consumers from the effects of tariffs.
But perhaps already that weakness showing up in the market. If you just look at the broad dollar weakness we're seeing this morning, a complete turnaround in the pound since that data has shown up, because ordinarily you'd see a stronger euro, a stronger pound on the back of that dollar weakness. This morning, the pound is actually weaker, and that's been a story that's changed in the last, about say, 90 minutes or so since we got that data. Still at a 135 handle, but certainly a data set that's sticking out.
Coming up on the programme, we're going to be speaking to JPMorgan Private Bank's Grace Peters and Stephen Parker on why they think US equities are poised to make new highs over the next 12 months. We'll talk US, rest of the world. This is Bloomberg.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
DoubleLine Group CEO and CIO Jeffrey Gundlach there talking about that American exceptionalism story. And we've talked about this from several different angles, from the trade perspective, from the deficit perspective as well. But I took a recent trip to New York about two months ago, and I had this crazy experience, which is what people are saying in Europe. The rest of the world may not be how it's being interpreted stateside. So we picked two people who are at the core of that conversation, Grace Peters and Stephen Parker, the co-heads of global investment strategy over at JPMorgan Private Bank, having these conversations about where we stand, visiting, of course. Steve is visiting from New York. Grace is a regular on the show. Steve, I'm going to come to you first because this is such a conversation right now, and it feels like there are two different views. You're here in London. Do you feel that difference between what you're hearing in the States and what you're hearing from international investors?
You know, I think when it comes to this question around American exceptionalism, I don't know that there is necessarily a feeling that some of the nearer-term trends around growth, technology, innovation are changing. I think the conversation that's evolving, particularly with our clients in the U.S., is more of a strategic question. And evaluating portfolios which for a long time have been going in one direction, which is towards U.S. assets, towards the dollar, now stepping back and reevaluating whether perhaps diversification, adding non-U.S. exposure makes sense.
So, Grace, hop on in here because this is your area of expertise. We just had Virginie Masnev over on from Allianz talking about kind of what that lazy complacency trait is, that when you're kind of in a cautious mode, she said you still go right back to tech. And we've seen that in this market, that the stock market has rebounded, the bond market kind of has rebounded. The dollar hasn't, though. What does an allocation to the U.S. look like in this environment?
Well, I think it does start with technology. And, you know, whilst there's been a lot of drama around tariffs so far this year, what has undoubtedly happened as well is reaffirmation of the AI story. When we go back to the start of this year, we were looking at broad adoption of AI across the US of around 5 to 6%. And latest figures imply that's more like 9 to 10% on an economy-wide basis. So AI is getting adopted. That is going to propel the US stock market. And so I think an allocation starts there. And just to build on what Steve said already, you know, the notion of US exceptionalism has got two sides, push and pull. And I think when we think about broadening outside of the US, you also have to think, well, what is Europe as a key region to diversify into? What has it got to offer? And I think there is a fundamental change to the European psyche that's taken place through the course of this year. A thought that they have over-regulated companies, under-regulated their own defence. And therefore, I think that sets the stage for diversification to look first and foremost in international markets towards European equities.
Yes.
And gold would be the other one.
It was interesting. We had a conversation from a tech forum earlier on in the programme, and our colleague Tom was talking to a tech venture capitalist who was saying what's happening in Europe, to your point, is a really interesting new mindset that people are prepared to take risks again, is the way that he described it. Now, that's tech in Europe. That's not the whole of the European economy. So are we talking about, in your conversations with international investors, are they just drifting slightly away from US assets? Is that a sort of correct characterization? Is it nothing more than that?
I think the first step is rebalancing. You know, there's been this unintentional and intentional drift towards US assets, perhaps away from some of the strategic asset allocations that were in place. So step one is rebalancing. Then I think step two is, as you say, thinking, well, what is my funding currency? Where do I have my spending needs? And again, in the context of, is that misaligned? And then I'd say, you know, this notion of there being a domestic story in Europe is new.
Yes.
When in the past we've spoken about why invest in European equities, it's often been driven by, you know, it's a global market. You get exposure to emerging markets, some US, and it's a nice globally diversified index. And it was more about avoiding the European domestics, including banks. Now I think that's changed, and we think that the European domestic story is far stronger, including banks, and also Europe is a more real asset-heavy sector, which I think is also a positive.
And how is that conversation, Steve, how is that conversation going down in the United States? How much recognition is there from the people you talk to about the opportunities that Europe can represent at this point, with Germany spending on defence and infrastructure and the other changes that we might see in terms of regulation?
I would say for U.S. investors, you know, we've had various points over the last decade where we've gotten more excited about Europe, and it's been broadly met with a high degree of skepticism. I think today the conversation is resonating. I think the changes that we've seen in Germany, the willingness to spend and increase the fiscal push, particularly one story that's resonating particularly well is this defense story. We know, we see the headlines, we recognize that there is going to be a commitment to ramp up defense spending, infrastructure spending. So all of those things are resonating more with U.S. clients. But like Grace said, this isn't a wholesale shift out of the U.S. into Europe. It's more of a rebalancing story at this point.
Yeah, we often talk about US exceptionalism as diminished, not destroyed. And so ultimately, portfolios are still tilted towards the US, but, within that context of making sure they're properly diversified and rebalanced.
But in that diminished, not destroyed narrative, the euro seems to be on a tear at the moment. And a lot of that is coming from the fiscal impulse that Anna was discussing there. But Steve, from your vantage point, there's a lot of questions here about this is the euro's moment to shine. Mm-hmm. Europe is traditionally associated with a cyclical tilt as well. I don't know if we're in a cyclical moment necessarily. Is there merit to the idea that the euro functions as a safe haven currency or in Christine Lagarde's perhaps hopes one day, eventually a reserve currency?
Yeah, we don't see a change in the dollar's status as the reserve currency of the world. There's really not an alternative to the dollar. But what we are seeing is that similar rebalancing dynamic that you're seeing in equity portfolios is happening within currency portfolios as well, right? The world has gone very long dollars, and I think most investors acknowledge that the dollar, from a valuation perspective, has probably been extended for a while. It was some of these changes from a policy perspective, from a growth perspective, that are now causing both investors and central banks to reevaluate the diversification in their FX portfolios. And the euro and the yen are probably the two top destinations for that rebalancing, along with gold.
So, Grace, where does the UK fall in all of that? It feels they've done something very special here, I think, that they've navigated the relationship with the United States. This is respectively speaking to how the EU and others are being thought about, and with China quite deftly and quite carefully. And that, I think, has boosted the pound as well. How long does that UK exceptionalism perhaps last?
Well, I think the economic backdrop in the UK is more challenged, actually, despite some of the drivers that you mentioned. We've obviously seen weaker GDP, weaker payrolls. Inflation is still an unknown, as it is around the world. And so our allocations are tilting much more to the Eurozone rather than the UK specifically. I would say an interesting dynamic to us is actually within UK domestic mid-caps, where you're starting to see more signs of M&A, in terms of currency, but also relative valuation is really, I think, the key driver there. So that's definitely something to watch. But broadly, these trends around infrastructure, defence, they are more tilted to the Eurozone rather than to the UK market.
OK, and we've talked about, in our trip around the world, Grace, we talked a bit about Europe and the United States. That leaves a whole lot of the rest of the world, doesn't it? Yeah. And we've maybe touched on China a little. What about the emerging market story? Because we were talking about, from the debt side earlier on, how, with our guest at 7:15, about how some of the debt nervousness in global markets is being driven by developed markets, not EM, right now. And I wonder where you see the opportunities in EM versus DM at this point.
So when it comes to the debt dynamics for the developed world, actually, the interesting thing to us is that overall debt, like if you think US consumer, household and government debt, it hasn't significantly changed. It hasn't increased. It's just there's been a shift, which is why I think we feel developed world corporates and households are actually in a resilient place, and we prefer developed world investing over EM investing. I would say, look, there are pockets within emerging markets that look very interesting to us, and I would call out Indian equities as really top of that list. The best GDP growth in the world, we think, this year and actually structurally over the longer term. And most importantly, it's a region where that GDP growth actually translates into earnings growth, which is not what you see across all emerging markets.
So if we see balance sheets for corporates and individuals maybe not quite so stretched, that leaves governments and developed market governments. We have different questions and different concerns there, and that's being reflected in long-end yields, and we've talked quite a bit about steepening of curves as a result. Is that something that increasingly investors that you talk to are preparing for?
So it's something that is coming up in a lot of conversations, but it's interesting. I was actually reading an article the other day about concerns about budget deficits, what it would mean for growth and for inflation and the U.S. Treasury market. And then you looked, and it was an article from June of 1970. So this is a concern.
Did that feel good or bad? I'm not sure.
Well, I think markets have done okay over the last 55 years. I'm not trying to dismiss the risks associated with the budget challenges that we're facing right now. But we have to keep in mind we can't manage portfolios around black swan events. And we don't know when markets will decide that this is a problem. So what do? One, in the near term, we are more cautious on the longer end of the curve. We think that to the extent markets begin pricing in more risk, that's where it will happen. And then we lean in on diversification. At the end of the day, that's the best way to navigate some of these challenges. And importantly, diversification doesn't just mean bonds to complement your stock portfolio. It means alternatives, things like hedge funds, infrastructure, that will be more resilient in periods where debt concerns are higher.
That's why we've called our outlook comfortably uncomfortable, because there are obviously all of these things that make you feel very uncomfortable, but I think there's also a lot of things that we can do practically in the portfolio to account for the base case, but also the tail risks.
So there's an argument here. You both made the argument that bringing in alternatives may be a kind of spot to have a little bit more carry, a little bit more yield in your portfolio. We were just a super return in Berlin last week. These are still fairly illiquid assets. And a lot of the drivers that are creating the sell-off perhaps in the long end of the bond market arguably are the same drivers that would affect the private markets. Why would you have exposure to a long-duration asset, whether it's the bond market or the private markets, if you're worried about volatility and a comfortably or uncomfortably comfortable, whatever you just said. Comfortably uncomfortable, say that 5 times fast, element in this dynamic. Wouldn't you want a more short-term exposure?
So I think when it comes to fixed income, I would fully agree. You know, when we're thinking about short to intermediate duration, that to us is the sweet point on the curve. But for infrastructure assets and some of those private market assets, actually the illiquidity works in your favour. And what you're trying to get is income with inflation protection, upside inflation protection as well. So I think core infrastructure is hugely complementary to the issues that you highlight.
So, Steve, I think the U.S. has the edge in this and getting that exposure to the private markets via an ETF, for example, or a little bit more accessibility than perhaps European investors have. Are you seeing that interest from more people that are outside of just the traditional institutions?
We are. We're seeing a beginning of this trend towards the democratization of alternatives. You mentioned ETFs. You know, we're looking a lot more at things like evergreen funds that offer a higher degree of liquidity, and in fact, that's becoming a much bigger part of the market. And part of the potential story and part of the structural tailwind that you may be seeing in these markets is with greater access to these alternatives, with more capital flowing in that direction, you know, that's going to mean more demand, higher bids for assets, and so clients are looking to get in early using some of these new tools in the toolkit.
It's a fascinating conversation. Grace Peters and Stephen Parker, the co-heads of Global Investment Strategy, JPMorgan Private Bank, talking to us a little bit about everything. I think we took a tour around the world, Anna. We talked a little bit about private and public markets, but I think it feels like the conversation keeps coming back to the policy emanating out of the States.
Right, yeah, let's get back to the trade narrative and the trade headlines, because we've had some further news headlines coming through from China. You'll remember earlier on this week and just yesterday talking a lot about Chinese rare earths and how much they're prepared to export them to the United States. Well, China is saying, this is a Ministry of Commerce spokesperson speaking at a press conference, saying they will continue in China to issue more rare earth export licenses. And China says it's already issued some rare earth export licenses, so perhaps trying to give a sense of action post that conversation between Xi and Trump, the two presidents then giving the green light to the framework to sort of double down on the Geneva agenda, I suppose would be one way to describe it. The wider relationship in terms of trade between China and the US, still many questions about that, but at least around rare earths and some tech and aviation parts, we seem to have a little bit of clarity. Coming up on the programme, we'll pivot to the UK. Kriti was just talking about the UK economy and the investment outlook there. Following the UK government's multi-year spending review, we'll get reaction from the shadow Chancellor Mel Stride from the official opposition, the Conservative Party. That conversation is next. This is Bloomberg. Welcome back. This is the opening trade, 8:47 here in London. And European equity markets on the back foot. We are down by more than 1% on the Xetra DAX. We've had global trade headlines moving sentiment a little bit, and we see a little bit of worsening in the US futures picture as well. So we're down around 0.4% on E-minis and Nasdaq futures. The FTSE 100 is going its own way, and that has a lot to do with energy prices, what we've seen over the past 24 hours in terms of the oil price and how that translates into energy stocks. So with the energy sector, one of the few sectors that's moving higher in today's trading session. That helps the London markets to outperform a little bit. Let us stick with what's been going on in the UK. The UK Chancellor, Rachel Reeves, has announced a spending review, this over the last 24 hours, of course. It confirmed tens of billions of pounds of new funding to renew Britain's infrastructure and public services. Crucial to that, infrastructure such as trains and road construction, but also investment in the NHS. Let's listen to what she had to say.
Defence spending will now rise to 2.6% of GDP by April 2027, including the contribution of our intelligence agencies. That uplift provides funding for my right honourable friend, the Defence Secretary, with £11 billion increase in defence spending and a £600 million uplift for our security and intelligence agencies. This government is investing in the biggest rollout of nuclear power for half a century. A £30 billion commitment to our nuclear-powered future. Yesterday, my right honourable friend, the Energy Secretary, and I announced £14 billion for Sizewell C, producing the energy to power 6 million homes, supporting more than 10,000 jobs, including 1,500 apprentices. I am increasing the financial firepower of the British Business Bank, a two-thirds increase in its investments, increasing its overall financial capacity to £25.6 billion, to help pioneering businesses start up and to scale up, backing Britain's entrepreneurs, backing Britain's wealth creators. I am proud to announce the biggest cash injection into social and affordable housing in 50 years. A new affordable homes programme in which I am investing £39 billion over the next decade. Direct government funding to support house building, especially for social rent. And I am pleased to report that towns and cities, including Blackpool, Preston, Sheffield and Swindon, have already had plans to bring forward bids to build those homes in their communities. I am proud to announce today that this Labour government is making a record cash investment in our National Health Service, increasing real terms day-to-day spending by 3% per year for every single year of this spending review. An extra £29 billion per year for the day-to-day running of our health service.
That was the UK Chancellor, Rachel Reeves, of course, speaking in the House of Commons, delivering the spending review. And this is the first opportunity for the Labour government to really present their spending priorities. Of course, we knew from the budget at the end of last year, in 2024, about the amount of money they'd have to spend. So it wasn't really about the amounts, but this was about the priorities. This was about how much they would put into various parts of the economy. And despite the ever-changing constraints, I suppose, when it comes to bond markets globally, when it comes to pressures around defence spending, trying very hard to prioritise some kind of investment in the UK economy.
And at what cost? And you mentioned that defence spending is such a key piece of it. And this is a conversation that's not just happening in the UK, it's happening around the world. And then as you have these shifting priorities and, by the way, a cushion to deal with perhaps tariffs that are coming down the pike and the ripple effect there, where does that turn around? On top of that, a little bit of a currency impact as well is worth including. I'm sure Rachel Reeves has one eye on the pound as well, some weakness this morning. But it's interesting to see how much of that might be reactionary to how quickly they can implement some of these changes she's talking about.
Yeah, absolutely, because when you invest in productivity, sometimes the payback is long-term or medium-term rather than short-term, and the GDP challenges are clearly quite here and present and current. But having said that, some of that coming through from President Trump's tariff policies, and that seems to be what's in the ONS conclusions this morning. Let's get reaction from the official opposition. The Conservative Shadow Chancellor Mel Stride joins us now from Westminster. Thank you so much for joining us, Mel Stride. Thank you for being with us on the programme. So despite the near-term challenges that no doubt the Chancellor faces, do you welcome the fact that this is a government trying to take seriously increasing productivity in the UK economy, trying to invest in technology, investing in healthcare, investing in infrastructure around the UK? Is that something that you would welcome?
Well, naturally, we need to improve productivity and growth in our country. The reality is, under this government, it isn't happening. And I think the question you have to ask about all this investing here, investing there, investing elsewhere, is where is that money coming from and can we afford it? And the reality is that the money is coming from a lot of taxation, A lot of that falling on businesses, about £25 billion worth through national insurance increases for businesses, which is destroying growth. It's also coming by way of very large amounts of borrowing, which has been inflationary. Inflation is now almost twice what it was on the day of the last general election. That's keeping interest rates higher for longer. And in this sort of national debt that's being accumulated, we're now paying on that national debt about 100 billion a year, which is twice what we spend on defence.
Okay.
So I think we're in a position that's very fragile, and the economy is going to be struggling to really digest this level of additional borrowing and spend.
Well, it seems that the market is increasingly pricing back in some of those rate cut expectations from the Bank of England, and partly because we've had weak GDP data out this morning, and I'm sure you'll lay the blame for that at the Chancellor's door. But I wonder if you accept that actually this was to do with US policy, US tariff policy, one of the drivers of the weakness in the GDP print today. And to the government's credit, they've done a trade framework, at least, arranged a trade framework with the United States.
Well, you've used the word framework. They don't have a clear deal. And in fact, what manufacturers here in the UK are not clear about at all is exactly what tariffs, for example, on steel, we're actually going to be facing. But the reality is that the economy is in a weak place, and that is due to the choices that this government has taken. If you look at the fiscal headroom that the Chancellor built into her numbers back in the autumn budget, that was completely blown and more. She rebuilt that in the spring. Most economists think that will have evaporated again come the autumn. And that is not the basis on which one would go out and have this huge spending splurge that the government's now embarked upon. And yes, of course, things like tariffs internationally will have an effect. We may have to spend more on defence going forward. The various discussions with NATO going on at the moment. We may have the bond markets requiring more interest from us in order to continue to borrow. There are some unfunding commitments that the government came out with yesterday, which you'll have to factor in as well. All of those things, you know, economies have externalities. But the question is, are they building a strong enough economy to withstand those and sustain growth?
Yes.
And I think the evidence is that that's not the case, I'm afraid.
If you were in a position of having to decide what to spend the UK's money on, then, Mel Stride, how much would you be spending on defence? The conversation currently around 2.6% to 2027.
Yeah, OK, so the government said 2.5%. There's an extra 0.1 they've levered in because that's what we spend on our security services. We have said we should be going to 3% within this Parliament. The government has said they have some aspiration to go to 3% in the next Parliament. The reality is they're going to have to look seriously at putting defence spending up, and that's just going to be another thing that's going to weigh on our economy and comes back to the points that I was making earlier about whether we have a strong, growing economy to carry that additional cost, and I'm afraid at the moment that is looking very doubtful.
Mel, thank you very much. Thanks for joining us. Mel Stride, Conservative Shadow Chancellor. Thanks for spending time with us here on the opening trade. And the first 56 minutes of that opening trade, then, Kriti, have been pretty negative for European equity markets. The DAX continues to worsen. In fact, we're now down by 1.3% on the Xetra DAX. Some of the autos names under pressure, it would seem.
And then the tech names as well, certainly not getting the boost that perhaps we were expecting from Oracle as well. Several pieces of pullback across these markets. Also seeing weakness in the currency market as well. The dollar continues to weaken. It should have boosted the euro. It is. You're seeing some green on the screen there, 115 on that market. But the pound, a 135 handle and weakening as we speak. That does it for the opening trade. The Pulse is up next. This is Bloomberg.